Welcome back. I'm Pierre Daly, managing editor at advisoranalyst.com, and this is Raise Your Average. Co-hosting with me is Rodrigo Gordillo, president at Resolve Asset Management Global. Rod, good to see you. What's going on?
Not much, same old, same old. Fun markets to be around these days.
Absolutely. Our special guest today is Cole Smead, CEO and portfolio manager at Smead Capital Management. Cole, welcome. It's great to see you again.
Yeah, great to catch up with you and good to meet you, Rod.
Nice to meet you too.
Guys, before we get started, I want to introduce Cole. Cole Smead is both Chief Executive Officer and Portfolio Manager at Smead Capital Management, where he provides oversight for all company operations. He's lead portfolio manager on the firm's international equity portfolios. Cole brings his highly understated expertise and intellect to every aspect of the company's investment strategies. He's been an integral part of the firm since its establishment in 2007. In this episode, we're going to dig into Smead Capital's investment philosophy and 4 parts of Smead's current investment thesis. So stay tuned. Thank you for listening. And while the music's playing, please take a moment to like us, follow us, hit that subscribe button. And if you like the podcast, we invite you to leave a comment or review at Apple, Google, Spotify, YouTube, or wherever you listen to your favorite podcasts. That helps other folks like you find us.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Cole, welcome back. I know we already said welcome, but it's really great to have you on again. I know we just spoke a few weeks ago.
Yep.
I think today we'll have a slightly different conversation. And I think to start, I think it would be really helpful if you could tell us about your firm's investment philosophy and the discipline that goes along with it at Smead Capital.
Yeah, I mean, the foundation of our discipline really is housed in our 8 criteria. And our 8 criteria was developed by my dad, Bill Smead, back in the early 1990s. And it was really a synthesis of what he considered aspects of various great investors. So Peter Lynch, Sir John Templeton, Warren Buffett, etc. But I will say there's actually a name that most people won't recognize. There was a guy named Barry Ziskin. And Barry Ziskin actually launched a fund called the Z7 Fund that was actually taken, I think, if I remember it correctly, it was a closed-end fund that Drexel Burnham Lambert took to markets. And they called it the Z7 Fund because he had 7 criteria. And interestingly, one of those 7 criteria was you had to buy a stock at 10 times earnings or less. And then if it hit 20 times earnings, you had to sell it. So think of kind of like smart beta, you know what I mean? Back before we had smart beta is how I think about some valuation aspect of what Barry did. But one of the stocks that Barry identified early on was Nike, oddly enough. Now, let's just sit down and think if like a PM had bought Nike in the 1980s and sat on it and just maintained like a 5% position, right, for, the last 40 plus years. They would be the most well-known mutual fund manager of the last, 40 years, frankly. They'd be personal friends with Phil Knight, to be downright honest. So I say that because, watching, you not only learn it by seeing other people's criteria, but you also learn from other people's mistakes. And using that, I know who Barry Ziskin is, but no one else in the public investing sphere knows who Barry Ziskin is today. Oddly enough, he actually ended up in Mesa, Arizona, not far from us towards the later part of his career.
Yeah.
But I point that out because that's really, that was really integral, was to, be able to watch those other investors. And what I really like about our 8 criteria is, markets change and our discipline doesn't have to. So, what our investment philosophy gets us to today is owning things like oil and gas, kind of like you and I talked about, Pierre, in our last discussion.
Right.
But, 10 years ago, we owned 0 there. We didn't own anything. So it's intriguing that, people think, that you have a discipline. It's so static. Well, the discipline is really a negative art. You're eliminating things. You're not trying to find things that fit. You're trying to prove things don't, and then you don't have to do anything from there. But the markets do change, and change comes. And whenever I hear people talking about, we'll never own this, we'll never own that, that's like saying they know the future, and therefore they already know based on their discipline what's going to happen. And I've yet to run into anyone that can ascertain that in advance. The only other thing outside of our 8 criteria I would mention is, we run concentrated portfolios, so 25 to 30 securities. Someone else could have our same 8 criteria, but run way more diversified portfolios, plausibly. We don't. That's not part of our discipline. And then we also know that turnover is a big enemy of a long-term investor. So we run, 15 to 25% historically speaking turnover in our portfolios. And that's, that's in effect our investment discipline in a nutshell.
Right. So Cole.
Thanks. Thank you.
So I'm a quant, mostly in the managed futures space, but I do read a lot of literature on factor investing. You mentioned that the individual that you highlighted was kind of the original smart beta. And so when I think about factor investing specifically on the value stuff, you mentioned that you have a disciplined approach, and I imagine that is a rules-based approach to filter certain ideas.
Yeah.
How does factor-based value investing or smart beta value investing differentiate from the type of value investing that you just described?
Yeah, it's a really good question. Let me give you an example just from an index perspective, because I think this is just kind of a nice place to start. So let's just use, say, like the Russell 1000 growth and the Russell 1000 value, right? Kind of two various factors, and when looking at either you have the value premium or you don't, in effect, is how I think about the growth side of it. And so using that, look at those indices. You'll find they actually share constituents. And the issue with that is when you share constituents, it's like, can value make up its mind? And so when I talk about the diversification that some of smart beta has, you'll see that it actually shares a lot of holdings with things that from a smart beta perspective, it might not agree with from a value premium perspective. So I think that's one way of looking and saying, why do we run concentrated portfolios? So we can focus on the things that we think are the most intense versus the things might be more diluted, but yet still represented in smart beta. That's one way of thinking about it. But to your point, I'll give you guys a study that I think is phenomenal. Kremers and Petagisto did the original active share study, which everyone's aware of, and it's been out there for quite a long time. But then Kremers, when he was still at Notre Dame, he did a follow-up study with a gentleman by the name of Ankur Parikh, who was at Rutgers at the time. And what they asked is they said, okay, we know active share is powerful, so let's use active share as a factor. And then let's also ask if turnover is a factor, back to my point about turnover. And what they found is that all the funds that did really well over their 25-year study had high active share, aka differentiated portfolios, and secondly, had low turnover. In other words, didn't waste their cost, to trading. They then said, okay, of that quartile of managers that did well over the 25 years, let's look into that quartile and let's see what other factors we can find in that quartile. They found 2 other factors, which was the value premium, and then secondly, what Cliff Asness has been arguing since I think 2013, QMJ, quality minus junk. Okay, so let's say we got to pull Cliff Asness on this discussion. Okay, from a pure investment perspective, there's 3 factors. Cliff would say there's value, there's QMJ or quality minus junk, and then there's momentum. And to your point, in our discipline, we have the ability to ascertain value. We have the ability to ascertain QMJ, but we have no ability to ascertain momentum, right? So in other words, we think about these things in light of the factors, to your point. At the same time, there's only certain things your discipline can or can't do. If someone asked me, Cole, why can't you figure out momentum? I'd be like, it's like a yogiism. You either have it or you don't.
Yeah, it's a value. It's a value thing.
Yeah.
I mean, everybody talks about what's the optimal way of investing. The truth always comes down to what are your values? What can you stick to long term?
Correct.
And that will define how you're going to approach investing. And I always tell the story. We used to go to a large pension plan in Toronto, and the CIO would sit us down to talk about momentum with their team. And it would be amazing. We'd have a 2-hour-long discussion, exchange ideas. And by the end of it, we'd say, so what do you think? Is there an opportunity for us to get some of that, momentum? So
Yeah.
Momentum. No. The chairman of the board doesn't understand momentum. It's only high quality value stuff that you're ever going to get. It's like, what am I doing here? Right? Like, don't you think that there's value in adding momentum to your book? It's like 100%. And there's all the data to back it up, but it's just never going to happen.
Yeah.
That's just value. The value system of investing is crazy.
Well, I agree. And by the way, here's the interesting part, and you guys have seen this, and I think this is a really interesting thing to think about. In the last 10 years, we've all ran into those people who said, "Oh, I used to be a value person," right? Kind of like, I used to be, and then I got to know
I used to be
Jesus,
an
and I'm no
alcoholic,
longer.
and now.
Yeah, exactly. And so, but and here's what's interesting to me. They say that, and then they say, but now I focus a lot more on quality. Well, now what are they really saying? They're saying, I thought this factor was an end all. I found out it wasn't mutually exclusive, by the way. And now there's this other factor, and I've greatly overweighted that factor in my portfolios. Okay. Now, the danger in that is you could set up this world where there could be negative alpha sitting in a factor and hugely positive alpha sitting in another factor. And I would ultimately argue that's what's going on right now. The quality world, or call it the quality growth world, is kind of getting its head kicked in while value is rocking and rolling, and everyone else is wondering what's going on. And again, it is the value factor. It is the quality factor. It is momentum, but how that plays out doesn't mean they're all mutually exclusive.
Yeah. I mean, there's value in having the diversity, even within value metrics. I think Wes Gray did a paper a few years back where he did a horse race between the different value metrics, right? And had you ranked your preference based on a back test, I can't remember, I think it was like 10 years ago, you would have chosen price to book or book to price, depending on what you're reading.
Sure.
And then, 10 years later, you're looking at enterprise value, sales over enterprise value, or something like that. And and the truth is, you don't know. And there's many ways to skin the cat, and that's just on the factor side. But if you are an expert in a space using whatever filters you're using, and you have a little extra touch, and you're disciplined about it, then you provide a value to the investment community.
Agreed.
So,
by the way,
I
was going to say, Wes, I think Wes had a really, if I remember correctly, what Wes, his research that I liked the best was he the gentleman that did What If God Managed Money?
What If God Managed Money? Yeah. He wrote that the day we wrote one that was exactly the same, but with our managed future stuff.
So I love his study, because here's what so everyone's looking and saying, because he ran the God portfolio where it was like the top decile of stocks that, you own for this whole set period. And he showed the returns. Okay. And obviously it had a great risk adjusted return. And then he showed the God portfolio, which was owning the best decile minus shorting the worst decile. Okay. Now here's what was interesting to me. Again, because God made the best money doing that. But the catch was that the volatility went way greater. Okay. In other words, if you're just sitting back and saying, what am I learning thematically from this data set? To produce the highest returns, you must accept much higher volatility in the underlying securities. That's what Wes's study ultimately argued. So when people say, well, Cole, it looks like you guys run higher volatility, it's like, yes, the name of the game is get very, very wealthy. You don't care how you get there.
So this is an interesting point. This is up to my next question, because the value managers tend to have higher risk.
Correct.
And so it kind of fits within the risk return discussion. And when people say, well, that's too risky for me, there's a few things to consider, right? Number one is, how is that extra risk acting as a diversifier to, number one, your traditional equity portfolio, and number two, to the rest of the asset classes that you run?
Sure.
And so when you do a factor-based analysis, and Wes runs very concentrated factor-based value portfolios, what you find is that volatility has information, right? When you do a factor analysis against any value manager, what you're going to find is you're going to find the beta to the market, so how closely their return stream is, and then you're going to find the beta to value, and these are stacked on top of each other. Okay,
Correct.
This is not so. Let's say that the stock market runs at 15% volatility, and your fund runs at 30% volatility. And when I do the analysis, I find that you have a full unit of beta, of SPY beta, S&P 500 beta, and you have a full unit of value. So in essence, what you've done is you have increased the capital efficiency of your portfolio, right? If you're putting in, if you have $100, you put 90 in your 60-40 and 10 into that value portfolio. What you're really doing is you're adding 10% on S&P and another 10% in something completely different, which is the value factor, as an example. And so I think part of that argument, it's higher volatility needs to be, yes, but a lot of that volatility, because it's so different, might actually reduce the overall volatility of your portfolio. Well, I think that's a discussion that's not being had enough within.
Well, I'll go one step further to your point on that. So the reason why I bring up Wes's study is I gave I gave a talk, and I can't remember exactly the title of my talk, which probably doesn't bode well for me, but I gave it 2 years ago at an internal retreat. And I think I call it the willingness to underperform was the title of my talk. So I looked at his study, and then I went out and studied. In fact, I'm trying to remember. James Grant has all the Sequoia Fund returns in one of his books going back to when they launched in July of 1970. And so if you took Sequoia Fund, if you took the Munger Wheeler partnership, if you took Berkshire Hathaway, and you took various investors like that. Sir John Templeton was another one that we used. We went all the way back to the Templeton Global Fund. What the weird part is, to your point, is I can go out and prove that each of those quote unquote great investors had to make up a 40% cumulative outperformance stretch to get back to beating the index at some point. Okay. So when I hear these people say like, oh, our whole industry is built right now around trying to reduce volatility. And the other part about this is, to your point, you could go back and look at volatility, but if you said, Cole, what's volatility from now to the next year? I could tell you only God knows, because honestly, only God knows. So I find it interesting when volatility can shift pretty rapidly. Think of what volatility of the energy space was, the last 10 years. And now you look, it's like this massive diversifier, to your point, in portfolios that no one had expected. It's actually making people look not so stupid in so many respects. And so I that's the weird part to volatility is as a measure, like back to my point on momentum. Why do we not use momentum? Because we have no ability, to your point, in how we value businesses and how we go out and approach what we do to go out and price it. In effect, we can't price momentum. We have no ability to do that. But just like I can look and say, okay, I can understand the quality of the balance sheet. I can understand how sticky the customer is and how sticky, the free cash flow or earnings power of the business is. But if you said, okay, they're in a transition season, what does that mean for volatility? I don't know. I can't know that. So to your point, I really agree with the idea of understanding who you are as an investor and therefore what you should value in your discipline to go out and make money. That's actually unique to us each individually. That isn't something that we can commonly just attach to and say, by God's grace, I'm a value person like everybody else. But people often do that right after that season was awesome, right? So by 2003, everyone was a value investor because no one was going to be a growth investor.
Oh, yeah.
Right now, now everyone's a quality investor, right? Because, all those value investors are stupid.
It is. And this is where I think what my goal for every investor listening to this is to recognize the value of diversification rather than being one thing or another, right? Cole, you talked about a value manager. You used to be a value manager, then you had a come to Jesus moment because it's a quality manager. The reality of we don't know which approach is going to perform in your lifetime or in the 3-year period that you're going to be judged against if you're an advisor.
Yep.
What you do know is that first you have to have confidence that whom you're investing with is going to have a positive expectancy. You have confidence that it's going to provide a diversified return stream, and then you got to put them together in a thoughtful way and rebalance. If you do those 3 things, you can include everybody you want, right? If you have those three premises to start with. And then when you're thinking about BlackRock value versus Cole Smead or Smead asset management value, the same analysis of how much beta versus how much of the factor you're getting in those large ETFs where you have to be large just because of liquidity.
Yeah.
It ends up being something like you get 1% beta as you get in the S&P or one full unit of beta and like 5 to 10%. So it's like 0.1 of actual value. Whereas with concentrated portfolios like yours, you're getting significantly more, right? I haven't done the analysis on your portfolios, but just by looking at your holdings, it's most definitely going to be a significantly powerful portion of a true diversifying value metric where you don't need to use leverage in order to get that exposure because it's already embedded in the ETF. So that's another important thing when you're thinking about if you're thinking about diversifying, you're just thinking in silos of value, momentum, quality. You also want to dig a little deeper into the managers that you're going to use to make sure that you're getting the most bang for your buck. So a word to the wise, I think concentrated value portfolios is the way to go. But anyway.
I didn't pay him to say that, by the way.
No, this is, just don't buy 100% Cole.
that is
Gotta
amazing.
diversify.
Guys, that was an amazing discussion. I just want to say, I was maybe a little bit worried, about, having a quant, versus a fundamental investor together.
That's a
not
loose
having
cannon.
a fight. No fight. No, there was
You
no
got to keep
fight.
it spicy, Pierre. You got to keep it spicy.
I love it. So, Cole, we appear to be at this major turning point. It's been unfolding for the last year, a change in regime, which I think you've very aptly described in your own, within your own philosophy and thought process in your four most recent notes. So it's a perfect time to ask you about the points you made. I want to, I know we talked about this somewhat in our first conversation that we had a few weeks ago, but I'm still stuck on this. And I think we should start with the Jevons paradox. I think many investors believe that technology will ultimately reduce the demand for energy.
Yeah.
But as you pointed out in your note, Mark Mills, co-author of Bottomless Well and The Cloud Revolution in 2021, Bottomless Well in 2005, did a really good job of getting you and your vision past that cognitive disconnect. So can we dive into that?
Yeah, that'd be great. And by the way, Mills, I think I said this on the last time we visited, but Mills, you have to have a framework, back to our discussion about the volatility that's unknown in the future. What kind of framework are you going to use for trying to understand an unknown future? That's what Mark has really helped us in, is, he has a great academic and scientific background. And because of that, he's not breaking the law of physics when he says what he says. Versus I don't have to be a physicist to understand that. I just have to understand that Mark is he's well based in what he's coming from. And secondly, it's a great framework to go out and think about things from a practical, economic, and pragmatic perspective. So real quick, so the Jevons paradox came out of the fact that, at the time, in the UK, that Jevons, came up with this paradox. Coal was in short supply. And the fear was that if the abundance of coal-consuming products took off, that they would have a scarcity of coal. That was, in effect, the problem that Jevons looked at. And so the policymakers at the time, classic, they're like, oh, no, we have to limit this because we're going to run out of coal. And the reality is that's not what transpired. Coal use greatly increased, and so did, therefore, the production of coal. But the Jevons paradox, for what it was used for, what you should ascertain out of it is, in effect, that because of the technological innovation happening in coal at that time, people didn't consume less, right? We didn't have a scarcity of coal. No, they consumed way more. And that is really the most important part to the Jevons paradox, because many people today would say, hey, listen, we're going to create all these great technologies, which, by the way, we will. That's true. And because of that, ... they conjecture that, therefore, we're just going to use way less energy. And yet there's just no precedent for that happening. That's never actually happened in the history of the modern world. We've never used less energy doing all these great things in human society with all the ingenuity and all the innovation and all the technology available to us. And Jevons really, the paradox he created really pushes back on the scarcity of supply argument, as well as the lack of demand argument, because we always have more and more and more. So let's just use what we're doing right now. I mean, think of how much energy is being physically consumed while we do this podcast. I can see both of you over on video. It looks pretty clear. I know that takes real data. I know that takes real content, tons of energy. And by the way, the fact that it's going from one place to another, it takes energy to move energy. Okay. These are all Millsian thinking that I'm throwing out to you guys. So I just point this out because, again, we're not using less technology. If we went back to the Luddites, where it's the 19th century, you're in the southern United States and you're pushing an ox through the field. By the way, we use way less energy and we did way less of everything. Okay. So there's yet to be a point where we don't go out and do a lot more with the technological innovation. But the catch is that the technology actually is what requires a lot of energy. So I think we talked about, Pierre, like the laser, the LED.
Right.
These are all technologies that were highly efficient at what they did, And yet we continue to consume more and more and more. And I think one of the things that comes out of this is, we sit in the Western world, right? Where, generally speaking, we're all wealthy relative to the rest of the world, but we work in the investment business. So therefore, we're wealthy relative to the rest of society too. And in the Western world, whether it be Canada, the United States, the UK, etc., when you're rich, you can kind of pick and choose how you want to go about through life. That's true in the Western world. But when you're in Africa, when you're in Asia, you don't have those luxuries. You're glad to just have electricity day to day in some of those parts of the world. And therefore, economic growth is decided by the stability of energy, versus we're debating, what do we want to consider stable or not? That's a little bit different discussion. And so I think Mills has done just a wonderful job of helping us understand those kind of framework issues for getting to where we are. And it really gets me to this point where it's like, if we're going to be doing everything we're going to be doing in the cloud, like he writes about in his 2021 book, I think even technology people are massively underestimating the energy consumption of the next 80 years of economic growth, frankly.
So Cole, let me understand. I understand the framework, that there will always be a rise in energy requirement. The population of the world has gone parabolic. It's not likely to stop anytime soon, although some people may argue that, depending on what Elon Musk plans to do to get people to start having more children. And we talked about coal in the beginning. Now we have coal, oil, and other derivatives.
Yeah.
It's always a supply-demand issue, right?
Yep.
So when tell me about the thesis that comes out of this from an investment standpoint, because I could see it going many directions, not just a simple answer that is buy more oil.
Sure. Well, so to your point, so I think you think of everything I just said. Now, did you hear me say, hey, by the way, we're going to do way less renewables and solar? No, I didn't say that. So it's weird to think about, often people think in investing because you're excited about something, you must hate everything else in the space. And no, again, they're not mutually exclusive. Okay. So how I look at the world based on this framework is we're going to do more renewables. Okay. But we're going to do more of a lot because the needs are going to be so great. And I think that's what's really being missed. It's not, hey, I won, so you lose. It's the needs are going to be present. As an example, I was looking at a chart earlier today based on 2023 so far, and they show what they call the duck of California wind and solar consumption. And they call it a duck because obviously by 12 to 3 o'clock every day, wind and solar are actually doing their job finally at that point. But here's the catch. California's producing so much wind and solar, they can't use all of it from 12 to 3. Okay? So what do? Well, you got to sell it as cheaply as you can get rid of it. And then at 8 o'clock that night, you're back again paying for a lot of energy costs because you can't produce it yourself. So I point that out because, well, what would tangibly fill that need? Well, that would be like lithium batteries. The catch is that if they're going to go on and doing more wind and solar like that, guess what? You need more lithium batteries. That's great technology, by the way. Those require a lot of energy consumption. Okay. And by the way, they deplete. Those metals deplete. So I find it really interesting as you kind of look at this framework and world. We're not saying, hey, we should be picking winners and losers. We're just saying, hey, you need more of everything. But it's interesting that the market is picking winners and losers. They're placing much higher valuations on some while putting much lower valuations on others. And I've got a great book, by the way. I'm finishing out the book Volt Rush. I don't know if you guys come across it by Henry Sanderson. He actually explains like the history of the lithium battery. It's fantastic history. It's two inorganic metals that have been put together as a hybrid, one the negative electrode, one the positive electrode, and then you have another metal playing the cathode in between. I call that a hybrid battery is what it is. Right. Now, I find it interesting that in that hybrid approach to lithium batteries, what we know as lithium batteries, all the academics and scientists say, oh, that makes sense. We put these two inorganic materials together. They didn't seem like they made sense, but in this battery format, they make perfect sense. And they're actually the lightest weight, greatest efficient use of our capital to do this. Great. But then if you go to those same people and say, okay, now, you know what electric motors do really well is they get to speed very quickly. But as we all know, the battery's really heavy if you have to run at speed for 100 miles. So therefore, it doesn't run at speed very efficiently, but it gets you to speed very quickly. What does the combustion engine do bad? Well, it doesn't get to speed very efficiently, right? It's a combustion engine. It takes a lot to speed up. That's where most of the energy consumption is. But what it does is it runs at speed really consistently and efficiently. So I find it interesting that this group that came together and said, let's create this inorganic material put together to create a hybrid battery that is a superior phenomena while together would look and say, combustion engine paired with electric motor. No, that can't happen. Right? In other words, it's actually a hybrid like
that was
the lithium
GM
battery.
Volt. I remember when the GM Volt came out, it was a hybrid model. I don't know if it still is, but it was
correct, but,
a brilliant thing.
But you gotta remember, because so in a combustion engine, the engine is where all the weight is, right? That's where most of the weight is. And that's what is the negative to a combustion engine versus, as we all know in electric cars, it's the battery. So what you get into is a world where if you can have like a 4-cylinder combustion engine running you at your 70 miles an hour or 100 kilometers an hour as you drive along, but you didn't get to that speed outside of the electric motor, that means the electric motor has a very tiny battery. And when you're running that combustion engine at 70 miles an hour, 100 kilometers an hour, what are you doing to the battery? You're recharging it off the alternator. Well, that seems like a very interesting pairing of great technologies together, like the lithium battery, might I add. And yet at the same time, people in that camp.
I think there's, it is the new generation of people caring about the environment. And I got to tell you, Cole, I'm born and raised in Lima, Peru, a city of 10 million people. We get all the used cars that you Americans don't want. And there is some side effects to owning a combustion engine that lead to all types of cardiovascular disease, not cardiovascular, pulmonary issues, right? So there's also the unintended consequences of all of that.
Yeah,
right?
There's externalities, but I'll give you one other example. So if you go back and look at the history of the world, say the last 1,000 years, okay? Here would be I'll throw this out to you guys because I've never asked this question in a public format, so I got to ask it now. What is the bigger danger looking over the last 1,000 years? Is it a colder Earth or a warmer Earth, and why? So I throw that to you guys. What would you say?
So, I mean, that is,
Go ahead, Rod.
It is a colder Earth for sure. It's the biggest
Now,
danger.
but why? That mean my answer, my question would be why?
Simply because you can't get things to grow on ice.
Correct. You starve.
Yeah.
The history of the world is that a cold Earth starves us. Versus today, to your point, there are externalities to a warmer Earth. And yet at the same time, we have the least amount of starvation going on in the history of the world today.
Well, no, there's a greening effect to CO2 that few people talk about. I remember when I grew up, it was about deforestation. But because of the amount of CO2 that's gone out into the atmosphere, the Amazon
trees
has actually grown.
Yeah.
Right.
Yeah.
So it is, but it is, all of this is a matter of balance between different priorities.
Yeah, I was just about to say that.
Totally agree. Totally agree.
It all comes down
And
to
also,
balance.
ultimately, I run models. I know what I can model out, what I can predict. The most I think I can predict with our models is 5 days ahead, right? So the idea of whether we're going to go warm or cold over the next 50 years based on a single iterative model is really tough for me to swallow as a modeling person, right?
Correct.
The accuracy of these models are very difficult for me to understand. We don't really know.
Think of how people look at, say, active management or just anyone that invests money, to your point. The academics would ultimately say, use a firm like ours, use a firm like yours. They would say, listen, to be realistic about whether you're adding alpha or whether you can consistently repeat this, we need 50 years of data.
Minimum.
Okay, minimum. Okay, but
daily data.
Daily data.
Yeah.
Now we have I'll call it questionably 50 years of data, maybe 50 years of daily data in a population that, some would argue is millions of years. Others might argue is as short as 10,000 years. And we're saying, but we got the sample figured out.
I mean, the big issue is number one, whether it's a cyclical issue. Number two,
correct,
who caused it.
Correct.
All the causality versus causation versus correlation is a big issue here. But
agree.
We don't want to get peer canceled. This is a Canadian show, Cole. This is not, it's not going to be useful.
But you know what?
Peer.
I feel like we're talking around ESG, sustainability. To your point, Cole, about more wind, more solar. Well, more wind and more solar requires more lithium because you can't store the energy unless you put it into a lithium battery. And the lithium battery production requires a huge amount of energy to produce and a huge amount of energy to run and maintain. And then it has to be replaced. So eventually. And so when you consider what the costs are beyond the financial, what the cost is of energy, it does reinforce the thesis that, of the paradox. But I feel like, we've one of the crossroads we're at right now is that, all the extremism of sustainability and ESG it's not that it needs to go away. It needs to moderate. It needs to come back to a balance, the same balance that we're talking about with, CO2 levels and temperature of the earth, climate change, all these things, all these ideas need to go from being, radicalized to, back to something more moderate as well, where, everybody can, come together and coalesce around a balanced view of things, as opposed to, this imbalanced world that we're in right now, like where we have shortages because of 10 years of underinvestment for all the reasons that happened the last 10 years. And again, to your question, Rod, which is that, what's the thesis? Well, the thesis is that, we've had 10 years of underinvestment. There's imminent shortages as a result of the underinvestment. And then even with investment now, it will take 5 to 10 years minimum before those new projects bring energy online, or produce more coal, or produce the minerals and the raw materials to build all the things that we need for our infrastructure, for our energy infrastructure.
And so is that the thesis? The underinvestment is a big part of this thesis for you, Cole?
Well, so I would say it helps, but I'll give you another way of thinking. I'll give you another theory out there. And Jeff Curry from Goldman Sachs, he points out that if they just put a tax on these things and said, listen, we're just going to tax it to make it effectively acceptable across society. In other words, like, hey, great, there's an externality, we'll tax it for its burden, whatever that is. I'm sure we could debate the finer points of that. But he said then portfolio managers and asset allocators would go out and be able to allocate capital based on what's very profitable for them. And he pointed out, but that's not what it is. It's like people they're making investments under the fear of what the repercussion might be for owning it. In other words, like effectively getting shamed by their investors, by their institutional investors, whoever that may be. And I think what that does create is, and I'll use Joel Greenblatt as an example. Joel Greenblatt, his old books, How to Be a Stock Market Genius. He said that small investors have huge advantages. So let's say you're the Canadian retail investor or the US retail investor. You come in here and say, listen, I want to produce the kind of returns where I move up in line in the pecking order of my community, in the place I am. There's certain needs I want to meet, education related, vacation related, retirement related, whatever that is. Well, guess what? Those are your objectives. And you can go invest based on that, and there's no strings attached. Versus a lot of, I'll call it the big money management firms or the large institutional investors, there are strings attached everywhere. And that's why those portfolio managers can't go out and act accordingly. The number one rule in the money management business, in the industry at large, is never lose the client. Okay, never lose the client. Now, by the way, it doesn't mean go make the best returns. That's never necessarily rule number one. It's don't lose the client. And so that don't lose the client, that's really what's driving these pressures on these issues that to you guys' point, we could debate this for 4 weeks and we would never settle how to deal with this finitely. And therefore, it's the fear of how to settle it that has very much spooked the markets. But again, so we don't have any mandates on us. So what do? We're just allocating capital based on what's most profitable. To your point, Rod, is it producing a lot of supply shocks? Unequivocally. Unequivocally, it's producing supply shocks. I'll give you an example. We ran a screen. It's one of the few times we ever run a screen. I know there's so few. So we ran a screen. We said, okay, how many coal businesses out there, either met coal or thermal coal, have at least $3 billion of market cap in like everywhere but I think the emerging markets, and does at least 80% of their revenues in metallurgical or thermal coal? And the answer is there's 6 companies in the world that fit that. Okay, so just think, you got this big world, got 7 billion people, and we've baked down the entire coal market to roughly about 6 companies to begin with, which is strange. That often does not happen. You usually have a multiplicity of competitors in an arena. And to your point, what it's doing is it's leaving very few people in those kind of markets where people are just slowly exiting, right? They're slowly exiting. If you look at some of the buybacks that are going on in those realms. You can even see the minority investors. They're just slowly exiting that business to where you're going to wake up with oligopolies in these supply chains, where you're going to have 2 or 3 people that are willing to take the brunt of, the lack of financing. They're going to be self-financing in the end, because why would you ever want to have to deal with outside capital? And therefore, the pricing structures have to be rectified to show a lack of competition. And that's effectively what's unfolding. Nobody wants to be in the business. Great. The mafia had a bunch of businesses they wanted to be in that nobody else wanted to be in. And guess what? They were willing to break legs to make that money. And that's kind of where we're at on some of these commodity-oriented businesses. Also, to your point, Rod, there's like good commodities and there's bad commodities. We talked about lithium. Lithium could help solve part of California's supply problem. Great.
Yeah.
That's a good commodity. But all the things that are in the community where they actually make the lithium products and dig up the earth and take out the 7 or 8% lithium, where they get their electricity from coal, yep, those are bad commodities, even though they're sitting in the same neighborhood, right? So there's a duality, even though that we don't live in a dualistic world. We're building a duality that doesn't really make sense for your life or my life. But that's the way the markets are building this. So again, I look at this as...
like to your point, Cole, I mean, like those who want to invest in funds that invest in oil and those who don't.
Correct.
Right? There's this binary, I mean, to your point, it's becoming almost, it appears to be becoming binary, where you have investors, some investors, a cohort of investors saying, oh, no, I don't want fossil fuels in my portfolio. And then that's actually creating this huge inefficiency, that you point out in your note, buying unwanted assets. I think the idea, I think one of the points that you made in there that was really interesting, I think, and it goes with your screen, which is that most of those companies have more cash than debt.
They're self-financing because to our discussion, like Rod, think about it like this.
They have to.
They have to be, because you can't trust people outside of you anymore. Okay. So now here's the great part. Okay. So let's think of like normal business risks. Okay. The most common reason businesses fail is a poor capitalization structure. Okay. So quick quiz. Can they go bankrupt tomorrow? It's crazy. So normally in a cyclical business, like a commodity oriented business, right? Back to let's like think of like a QMJ framework, right? Quality minus junk. So, okay, cyclical businesses tend to struggle because their capital structure isn't usually good. When they run into those bad stretches, when profit margins drop way off because the commodity drops off, bankruptcy might be a question. But we're in a world right now where it is very common. You can find commodity businesses that either have no debt. Oil and gas have been swallowing their debt for 2 years now. It's depleting at a rapid case, and in some cases that doesn't make sense, but they're almost to where they're debt free. And then in the case, to your point, in like some of these coal assets, they already don't have debt. They have massive amounts of net cash. And because they're in the stock markets, they are like a Canadian stock market or like an Australian stock market. The buyback rules limit your ability to buy back enough stock to disgorge your cash.
Right. So you're kind of stuck in that paradigm, and you have to create a different way of managing a company, which is not traditional, where you have less debt, you're self-financing. And I guess it's not a bad idea if you're unable to get the right financing from certain banks, given the current market environment. But I will say one thing, just as a side note, with all these ESG extremes, we now see in true American style, the God Bless America ETF, ticker YOL.
Yeah.
My new favorite of all time.
We got great marketers in this country.
Bound to happen, right?
No, I agree. I know you're totally right. But so let's take what we just talked about, okay? And then let's take it together with what we talked about from a factor perspective. Okay. So the piece I'm currently working on is called The Game Has Changed. Okay. It's called The Game Has Changed. And what I do, this is really fun.
The basketball one?
Yes. So what we do is we explain the history of the 3-pointer, which, as we all know today, it came in 1979 to the NBA. And Larry Bird was a rookie that year, and he never shot a 3-point in his first rookie game. Okay. And by the end of his career, he was a 3-point shooter. So the evolution of the NBA, people figured out, hey, it is points per shot. That's what you're looking at, the efficiency of what I'll call the shot allocation. In our world, it's capital allocation. Okay. And so if you can make 50% from, 2-pointers, you need to shoot 33.33% from 3-pointers. That way you get, for every shot, you get 1 point on average. The efficiency. Okay. Well, if you go look at, it's Goldsberry who did the research, and by the way, it's funny part is I titled my piece that, and then I came across the research, and the title of the research was "The Game Has Changed." Oddly enough, which I felt, oh, perfect, God willed it. So what he shows is he shows a chart from 00 to 01 season where NBA players at that time shot a lot more 15 footers, 17 footers, 13 footers. But in 2019 to 2020, there was like 5 to 7 footers max. Everything else outside of that, of the top 200 shots, were in 3-point land. Now, why? Well, it's actually the same kind of thing that we were talking about earlier as you think about factor investing. For example, in the NBA, if you shoot a shot at 21 feet, you get 2 points. If you shoot 2 feet further back at 23 feet, you get 3 points. So why would you shoot a 21-foot shot? It's statistically tougher, and yet you don't get compensated for that extra risk. Back to our discussion earlier, thinking about the factors of this. So I explain this because to our discussion just a second ago, we're in a world now where I'll call it the 2-foot bank shot, right? The easiest shot to make on the floor is the S&P 500. Okay. That's the 2-foot banker. It's like the layup. Okay. Now, first off, I've seen people miss layups, just for the record. Okay. But it's interesting that right now, think of the easy money things that people have done a lot of the last 10 years. Those close-in shots, the S&P 500 being widely diversified. I'll call it like the quality story, like we were just talking about earlier. Well, those aren't actually winning the game right now, right? Those are not rewarding investors versus these riskier shot attempts, right? Commodity-oriented businesses kind of buying against the ESG framework, etc. Those things are producing marvelous returns, and yet it's like the rest of the league hasn't figured out that you could go out and take these threes.
It's classic cyclical value exposure,
Correct.
right? I remember
I
back
agree.
in the late 90s, I mean, the weighting of commodities was minute, the S&P. And there was a gentleman in Canada, a bit of a legend, Eric Sprott, who ran the Eric Sprott Equity Fund. And through that 2000 to 2003 period where NASDAQ got destroyed, and, you know, in Canada, we didn't do so well because we had Nortel. They were making double-digit positive returns. Why? Because they found that ugly duckling that nobody wanted. It was the commodity space. By 2007, it represented 25-30% of the index, and now we're back at it again, right? So it is really tough to get, like you said, Vanguard and BlackRock, those big players, to move out to the 30-point line to change their game, and they're not. You're going to need more nimble, thoughtful allocators in order to do
totally. Well, because to your point, and this is something I skipped over, and it's like you already read my piece, I think.
Yeah.
That was, the prior era to the 3-pointer was the big man era. Well, that's really what we're coming out of in the money management business and in the stock market. It was a big man era. It was a big money management firm. It was Vanguard. It was BlackRock. And you think of the constituents, the S&P, I think even right now, Microsoft and Apple are 14% of the S&P 500. And if you add the top 5 in total, it's 26%. It's a big man game. Yeah. So I point out, listen, if you're starting with a smaller capital base than all these other billionaires in the room, you're not going to win this game shooting the 2-pointers next to them. You got to go out. You got to find a different risk. Now, here's what's interesting. Did I say, hey, go take shots from half court that are insane? No, because again, you don't get compensated any more for hitting it from half court than you do from 23 feet.
There's an optimum distance.
Correct. Yeah. There is. Yeah. And the question is, who can? Because those big money management firms, they can't sink $1 billion into these things. Most of them are trapped out because of the size, which means that ultimately that smaller investor or that smaller manager, or that smaller fund has a distinct advantage in this environment right now.
And let's think about also what people forget about that period is that mid-noughts period was the decade of active managers. I mean, the Magellan Fund, and I could name the Eric Sprott Equity Fund. Like, he was charging 2 and 20 in a long-only fund and still outperforming everything. Like, it was, you can't even imagine something like that today, right? And everybody owned it. And when you have a shift like what we've seen in the last 10 years, where it really is the big man game, where you got the big players dominating retirement portfolios and life cycle funds and just needing the liquidity of market cap, and you will have decades where active management just does underperform. But there's an ebb and flow to this life, and you're going to need to start. My fearless prediction, don't take it with a grain of salt. My fearless prediction is that 10 years from now, everybody will want active management and recognize how silly it was to have 100% of your portfolio in market cap, right?
Well,
Because you have to.
I agree. Well, I mean, to your point on commodities. So, if you look at the this was the worst drawdown on a relative basis of stocks and commodities. It wasn't as long. If you look at the duration of this, it wasn't as long as other periods, but the drawdown on a relative basis was bigger than it had ever been. To your point,
2011 to 2021, I think. 2020.
Correct.
Yeah.
2021. That relative drawdown was the biggest spread between those two. Now, here's what's interesting. I think this is LaForge at Wells Fargo. He had a great chart looking at, okay, here's equity bull markets, and then right below it, and he shaded it. So here's like the bear markets of equities. And he showed the commodities over that time period. And the bear markets of commodities typically come in stock bull markets. And the bull markets of commodities typically come in stock bear markets. So it's interesting to think, again, that's why it's a higher risk phenomena. It doesn't produce as high of a return as stocks do. At the same time, you can commonly find, to your point, like in the 70s, like in the 2000s, where these places produce really good ways to compound your money, while not a lot of the people make very good money. And that's kind of what we want to do.
I show a chart every day from 1970 to 2 years ago, before the uprun in commodities.
Mm-hmm.
And just the commodity index, the Deutsche Bank commodity index, outperforms everything. Like it outperforms equities, bonds, gold. It just, of course, it has a decade of flat returns, a 75% drawdown. But the point being that, again, talking about diversity, having a willingness to get back in, right? Having an exposure to that space that might be overexposed for a while the volatility is high and the opportunities are there. And I do want to just kind of circle back. There's a lot of positive points with regard to why there's a supply disruption, why there's a demand benefit for energy and all the players that are going to benefit, and the good and bad things of lithium and good and bad things of everything.
Yeah.
But we actually did an interesting podcast with a man you've never heard, Alonso Gonzalez from Mexico. He's writing a book on this, about the abundance of energy that's coming down the pike. He is a glass manufacturer and started seeing the demand for glass go way up, started digging in, and obviously realized that it's because of the solar panels, right? Mm-hmm. But there is a road here where, because of all this disruption, we are going to find ways of making those very expensive things cheaper. And he actually goes into, right now it's really expensive and really damaging to the environment to actually produce lithium. But 2 or 3 plans are out there that will actually, like Elon Musk is, for example, going to have a soup to nuts supply chain where everything is going to be done via solar, from the production at the mines, which doesn't exist today. That's where most of the pollutants happen, all the way to, bringing out the batteries for use. And the battery technology is improving. So there will be a shift here. But if you look at the numbers, it ain't going to be anytime soon, right? I don't mean it's not going to be next year. And we're talking about thesis that'll last maybe a half a decade, maybe more. But eventually this will turn. And all of a sudden, all those nasty arguments for lithium batteries and copper, and it just, they'll turn around and
I
find a
disagree.
new thesis, a new ability to make money in a different sector. It's a willingness to shift to things that are
Well, and so go back to lithium. So the original lithium technologies were created about 40 years ago. And if you look, to your point, since then, they've gone down 90% in cost. Okay. So they're already seeing classical supply curve pricing functions going on. Completely agree with that. Now, I'm gonna go out, and I hope this warps everybody's minds, because we talked a lot about like the supply, what can meet the supply, what is going to be supplied, etc. Okay. But here's the catch. A lot of people that are really excited about solar, wind, and lithium batteries, they tend to fall into a camp that would say we have too many people on the earth. And I actually, like, back to Musk. Musk is right sometimes. And one of the things he's sometimes right on, he said, listen, the risk of the world isn't too many people, it's too few people. Okay. So all the modeling we're doing in the Western world, the way we're trying to kind of think about this, we're assuming really one thing, that in 80 years, 80% of the population in the world will be Asian and African, because that's what the UN, for example, dominated by Western governments, is forecasting. And the real risk, and I totally agree with you, Rod, on this, is that we wake up in a world where that doesn't end up being true, We have way more people than even they model for in the Western world. And if you have that happen, the need for tighter supply costs become far more valuable. And the idea, I think one of the great myths, and I'll throw out one other book if you guys have come across this, but Marion Tupy and Gail Pooley wrote a book called Superabundance. If you haven't come across it, it's such a great book. But they point out that if you measure all these commodities or anything we buy day to day and look at the history of those goods, those inputs, whatever that may, in time prices, where let's say you use unskilled wages or skilled wages or white collar wages, no matter how you want to track these, if you compare 50 years ago to today, what you'll find is all along the way in time prices, all these goods are getting cheaper and cheaper and cheaper. Because to your point, Rod, the technology, the innovation that comes with them causes us to be able to buy them for less of our time each year. Okay. And what it does is it creates, this superabundance is what they argue. Now, part of the reason they argue for this superabundance is because there's so many more people in the world creating so much more brilliant ideas. And so if someone said, Cole, what's the biggest argument against this idea of superabundance and these increasing gains? Well, if we don't have enough geniuses born just from a sheer lack of number of people being born, just so you guys know, I'm a quantity over quality kind of person.
I thought you were about to say you're a genius. You're one of them.
No. I was gonna say if you have 1 billion people, you're gonna have the same number of geniuses per 1,000 people, which means you're just gonna have many, many greater solutions to all these problems. But if you don't have that billion people, you're gonna have fewer Musks, fewer brilliant people like Warren Buffett. You're gonna have fewer great thinkers like Cliff Asness, which means you might not get the blessings of those gains that you're talking about, Rod, if we don't have all these really brilliant, ingenious innovators in society. And I think that's the real damage, is that we kind of like scare people off of being fruitful, multiply, subdue the earth, have dominion. And you know what? Better yourself, your family, and your society.
No, one of the saddest things I keep on hearing from 20-year-olds in my life is how terrible the world is. I have to remind them,
Totally.
you've never, ever lived in a better time in the history of the freaking planet. And, coming from Peru, I would say that, and having been brought up there, it is so good to be alive right now. And it's so brutal that these 20-year-olds are just not making enough love. You know what I mean?
Really
avoiding their willingness to get married and have children.
They know the price of everything and the value of nothing.
Yeah. Well, I just like, it's like, to your point, I mean, if you just stopped and said, okay, look at your life expectancy, look what you can do, look at the educational attainment you can find, look what you can go do in your work, your business, what you choose to do in your life, who you can choose to marry, etc. Okay. I do not understand how this is a bad world. I've yet to chalk. It's incredible.
It's truly unbelievable. I think Elon Musk is going to solve all the algorithm problems and get him into a happier space. I know his ultimate goal is to make people have more children via Twitter. That is my
with a blue check, right?
With a blue check. If you pay,
did anybody
with a blue check, you will have.
Did anybody imagine like how much you could do at home?
No, it's
before COVID.
It's crazy.
If you truly just take a minute to think about how good it is, it's just, you can choose to be all downtrodden about everything in the future of the world. But I mean, even ChatGPT and all the tech that's coming out can make people feel, you can take it that direction, or you can choose to use it for good and make your life easier, better, faster in every respect. And so,
So to your point, I mean, if you look at it in an Orwellian lens, okay, did the Luddites lose? Like, supposedly they would. And the answer is no. All the farmers' kids and grandkids are now very wealthy because it's fewer people running larger farms, dominating the agricultural landscape of the United States and really the world. In other words, they gained, even in that Luddite-style business, in an Orwellian lens, they gained all the returns on capital that were accruing to them for their ability to reinvest and innovate and do all those things themselves. So I think, like to your point, what industry has not received greater economic returns from what we've done the last 20 to 50 years? I mean, it's very hard to find an example.
It's a great point. It's a fantastic point. Well, so just Pierre, you can edit this out, but that was my daughter reminding me that I have to go. So if
figured as much.
That'd be awesome. Call a great combo. Anyway, we'll give it a pause and then go.
Hey, Cole, I wanted to ask you just to cap off this discussion, because we've seen this rotation into technology stocks on the back of what, has been the other side of this discussion has been, what you very eloquently point out, which is cutting your way to prosperity. But, tech stocks, at least definitely the biggest ones, probably the biggest beneficiary of cutting to their way to prosperity is Meta, which you mentioned in your piece. What are your actual thoughts on technology stocks right now? Because it looks like the market has already priced in, Fed cuts. I think in your other piece, you point out the fact that we're more than likely in for persistent inflation rather than a reversion back to 2%, or somewhere in between. But we're definitely in for more persistent inflation, as opposed to the view that the Fed will destroy the economy and bring us back to 2% or less. What are your thoughts on the bet that investors are making off on technology stocks, that all this cutting activity and efficiency that technology companies are suddenly finding is the pathway to higher multiples?
So it's a great question. First off, think about this. This is funny. How did equity people become such bond savants these days? I just don't get that. It's like they could have cared less about the bond, market for a decade, and then suddenly they all can tell you what the 10-year treasury is and how that's going to help them. I don't get that. I mean, that's superfluous to me. But so to your point,
special thanks to Louis Ranieri, who made bonds exciting in the 80s.
Exactly. And Michael Bloomberg for giving us our bond prices on a regular tick by tick basis. So from a kind of a market dynamic, this looks like a bear. This looks like a bear market rally, a dead cat bounce in those stocks. I mean, it just does. To your point, if you look at the underlying, reports coming out of the business, and let's use Amazon as an example, the cloud hosting business is getting worse. If you think about, these were the businesses, these were like these blue chip quality American companies that are unstoppable. But if you actually look at their revenue growth in these segments that are supposed to be so dominant, in real growth, the real growth is declining rapidly as we speak. Because yes, we have inflation. So if you grow 8%, well, how much of that was just inflation? And the answer is the real growth is declining rapidly in those businesses. They were growing far greater in real growth terms, prior to inflation showing up. So that isn't what the market was pricing in. That's not what the market was expecting. I don't think the market's really come to grips with those phenomena. And I'll use Amazon as the picture because, if you're Amazon, the web hosting was that was the creme de la creme part of your business. In Google's case, it was digital ads. I think so far who's kind of gone the most unscathed, this is Microsoft, because Microsoft's hosting business is just as dependent on Office Suite growing because they share revenues between those two assets, right? If you're an Office customer, you're actually using some of the Azure in OneDrive, for example. So I find that to be a little bit interesting dynamic as we think about those. But I mean, just to think, we're supposedly going to end this bear market with a perceived winner like Amazon trading at 50 times earnings. That's not the way bear markets end. To assume that we ended a mania in stocks and other asset classes, and we're just going to have a cute little adorable bear market garden variety, that just seems so implausible. So in the interim, I think market participants are pretty lost. They don't know whether they should fight the last war. They don't know if they should pivot capital because, of the things we talked about in various mandates or whatnot. I think most market participants don't really have a good sense of anything of what they're doing. And I think it's just it's again, back to the idea. Everyone's still like, should we shoot the 2-pointer? It looks better than it did 3 months ago. And it's like, yeah, but you could still lose 20 or 30% of your net worth. Don't forget, Cisco never made it back. Oracle never made it back. Okay, those kind of things have happened and will happen, and that is very normal. In most cases, it usually takes 7 to 10 years to fix massively overpriced securities. I noticed Rivian's down 90%. Okay, great. That's a good start for that kind of, high exciting phenomena.
Right.
But the idea that this is over, I think that is very foolish. I would very much warn people that, hey, listen, what we've seen is tectonic. Just like as Hemingway said, things were gradual, then sudden.
Right. Yeah.
I think that's what we're going to see in this bear market too. We're probably only halfway through this. And so if there's anything, I mean, my excitement for these 3 pointers we talked about, these commodity oriented business, these cyclical business, I'm not saying, hey, gosh, stocks look so damn compelling at large, using the S&P 500. I'm saying there are a lot of terrible risks out there. And these 3 pointers look very attainable relative to taking such poorly timed 2 pointers out there.
Yeah,
that's a great point.
Cole. Thank you. That was terrific. Sorry, Rodrigo. I wanted to ask you, make sure we asked you before we closed our conversation, because I have a feeling people, some people might be out there thinking, is this, a FOMO moment? I mean, am I, that fear of missing out again, that things are rebounding and I'm going to miss it? Or is it just a head fake? And I think you answered that question, Cole. Thank you.
Yeah. Well, yeah, I appreciate it. And by the way, don't forget, the economy is not the stock market. And I think that's the other thing people are missing. The economy of the world, I would say, has been far stronger than people expected. And the S&P 500 isn't holding up under those conditions. That's a different thing.
I'll just end it like on that note. I wrote a piece called Bear's Grasp, how to survive in a multifaceted bear market. If you examine 2000 to 2003 and you look at value investing, or you look at like managed futures trend, they all did really well from point to point. But if you actually look at what happened, is it wasn't the tech crisis. It started with the tech crisis, then it was 9/11, then it was Enron, then it was a balance sheet recession, and there were many head fakes in between. And you look at the amount of time you spend treading water on those big winners over that 3 years. You spend 85% of your time, and specifically I highlight managed futures trend, but I could have done the same thing for value. Just basically making new highs very, very seldomly. But at the end of the day, it was something like 60% return from point to point versus negative 50%.
I was going to say, just by making that good of money, you're like, wow, that sucked. But that sucked even more over there.
It was brutal. And I talked to a veteran of the industry. I said, I can't wait for this next decade. It's going to be just like the 2000s. Like, I lived through that. That was the worst 3 years of my career, and I crushed it. So it's important, I think, what you said, Cole, is that it's not going to be easy. You're going to be hitting 3 pointers. You're going to probably be losing more of those shots, and you're going to miss
shots. You're going to miss shots.
But at the end of the day, you have to assess what is right for the goal when you have the goal in mind, the end goal in mind. It's just going to be a tough period for everybody. So whether you're a winning value investor, a winning alternative strategist, a winning stock picker or trader, it's going to be a rough go. I think it has already been pretty rough for everybody. And so that's, if you're an advisor listening, you got to educate, buckle up, your clients to buckle up, diversify, and recognize what the goal is.
Guys, that was amazing. Thank you so much, Cole, for your incredibly valuable time and your insight. Rod, I was afraid there might be a fight, but
nothing but love here, man.
It's good. No, it's awesome. I'm just thinking, sorry, before we stop, we should get Wes Gray on.
Sure, I'll invite him on.
And Meb Faber and Cole and you and do like a 5, a like 5 or 6. Style. Yeah, exactly.
Well, then you let the podcast listeners vote people off slowly over the episode.
Oh, I love that. Love that.
That would be awesome. All right. Thanks, guys.
Awesome. Good to meet you, Rod.
I truly have
Thanks,
to
guys.
run. Cole, the pleasure.